Welcome to Energy Unplugged, your go-to podcast for the global energy transition. I'm Oliver Kerr, Managing Director for Aurora's North America business. And today I'm delighted to be joined by founder, president, and CEO of Spearmint Energy, Andrew Waranch. Andrew, a very warm welcome to the podcast.
Thank you for having me.
So I'd like to start by asking you a little bit about your experience founding Spearmint. I mean, if I had a dime for every new battery developer that's popped up in the US over the last few years, I might not be rich exactly, but I probably have a decent chunk of change, enough for a beer or two. There was a time, I think, not long after the IRA passed it felt like every other week we were fielding a call from a new battery developer looking to enter Texas. So, not many of those succeed, and certainly not all of them have succeeded to the same degree as you guys have at Spearmint. So maybe you could just start by telling us, what is it that you're trying to do at Spearmint, and how is that different to some of the other players in this space?
Thanks for saying that. At Spearmint, drawing on my experience of nearly 28 years in the power space, having worked for utilities, banks, and hedge funds, and having watched storage back in pump storage days, watched how valuable that could be to the grid. When I saw the drop in prices around 2019, 2020, I realized exactly how that would change price formation across the US in every ISO, and that low-cost storage would drastically change the market in all regions. And I was motivated to sort of be an evangelist for storage, both on the development side, because it was obvious to me, whether it was something as small as 5 or 10 megawatt DG facilities or large-scale utility projects, that they were going to be everywhere. Sort of as in, cell phone towers had to be everywhere. I think the batteries have to be everywhere. And I went through the capital structure, and I said, there's lots of debt and equity, whether it's SFDR out of Europe or U.S. pensions, endowments, insurance companies, Asian capital. There was no shortage of project capital, even before the IRA, for contracted assets, but offtake was the big missing piece. And so we started with the idea to be both an off-taker and a development company. And I think that's what differentiated us. We came from the trading community. We came from the world of tanks and silos and granaries, where people understood that when times are bullish, you need storage to release inventory. And when they're bearish, you need storage to, take in supply. And how that had been missing from the U.S. power grid for 70 plus years. And I think what's allowed us to be successful is really having a team which is equally a blend of Wall Street, commodity trading, risk management, development, and a lot of young people with a real goal of saving the world. One of our slogans is, have fun, make money, and save the planet. And I think that is who we are. And it really represents bringing together of the best from all aspects of the people in the team.
No, that's great. And congrats at what you built over the last couple of years. We'll get into you mentioned a few pieces that I'd like to get into, but maybe just to start at a very high level, like, how would you describe the state of play in the US battery storage market right now? Sort of what's the size of the investment opportunity look like from where you're standing?
I think the ranges from the EIA to Lazard to Guggenheim and others, anywhere up to 700 gigawatt hours, maybe even a bit more by the end of the decade. I think it's absolutely achievable. I think the EIA on the low end is more on the megawatt side of 100,000. But I think it's quite easy to see. I mean, my personal view is closer to 200,000 with an average duration of just over 3 hours. Mm-hmm. And so about 600 gigawatt hours across the US. Everyone started with California because the need was greatest and the revenues were highest and returns were good. And they moved immediately to Texas because the same issue. Beyond that, now we see a much greater patchwork of the US where batteries are either almost economic or will be within 2 to 3 years. And so we're looking at projects in New York, New England, which I think there are some pockets and zones which are great places. We stay away a little bit from PJM because of the uncertainty and many reasons for that. But I think where we're focused almost, we're really hyper-focused on SPP and MISO. We think that some of the load growth in MISO and some of their own internal communications and forecasts about a lack of capacity are going to lead to very short-term imbalances, short-term supply and demand imbalances. And they really need lots and lots of storage for resiliency, not just for price, but really for frequency and resiliency. And so we're heavily investing in the Midwest, up and down across, nearly a dozen states. The West Coast is a little more developed in a sense that California has a lot of projects. It has a lot in the queue. Even Arizona, Nevada, they have quite a large queue. We have some ourselves. I think the need is great there, but it's also being addressed, as the need in Texas is certainly being addressed. When you look at some of the load growth estimates in Texas, if we really do achieve 6%, 7% annual load growth, that's an extraordinary number. I mean, it's truly an extraordinary number. And, even at the rate of solar, wind, storage, and thermal that we're talking about building, it's going to be hard to keep up with demand, given that the TDSPs don't have enough interconnect crews. The ISO itself struggles with just the sheer volume of interconnect requests. We are seeing anecdotally from our friends in the TDSPs that the number of requests for large load interconnects is as great as generators. Wow. And I think that came out of the blue for them. They had been so focused over the last decade almost on large generator requests that they were wholly surprised by the massive demand for. I don't think it's Bitcoin. I really don't. It's really edge computing and hyperscale data centers. We're seeing that in parts of PJM in Virginia and even in North Dakota, where we have a project, some very large load growth states. And so if the load growth is as high as we expect throughout the Midwest and parts of the East Coast, I might be low on my estimates for storage. So there's lots of places. It started with two very discrete areas, and now I think there are great projects to be had almost in every ISO.
Yeah, I think that's right. It's when I think about it, it's sort of ERCOT and CAISO I put in one bucket as the most mature markets, and then there's everything else. Well, so when you mentioned a few things there, but when you're comparing fundamentals and the opportunity across markets, you mentioned load growth, you mentioned renewables, thermal retirements, interconnection queues. What are you most paying attention to? I mean, I know it's a combination of all of those things, but are there specific must-haves when you're thinking about relative market attractiveness?
Yeah. And so first, at a macro level, we've seen battery prices drop tremendously, which has been good. We've seen availability of construction debt, tax equity, all robust, quite robust. And so the macro tailwinds are great, right? The IRA has been well received. Despite all of the election-related uncertainty, I think people are quite confident. So the macro tailwinds are there everywhere. On a local level, places like Massachusetts with Clean Peak and some of the Connecticut programs, clearly we're heavily interested in what NYSERDA achieves in New York. We've been following this. I've been developing in New York for 4 years. I think that NYSERDA may finally have it this time, and there might be a path forward. And then we look at all the other individual state mandates. And so we are heavily focused on the regulatory at the state level. Yeah. Right. I think that we've always been focused on that, but now that team of ours is growing significantly. I think we're in 11 states today, and it'll be 15 by the end of the year. Really understanding the regulatory environment, how market design is being rolled out in each state, in each region. So that's very important to us. So I would say right now, that's perhaps the newest focus for us. At the local level, of course, we do a lot of education on the benefit of storage. You have to do a lot of education on fire. It's a fear everywhere. We actually were speaking with some folks in the firefighting community the other day. There's just a lot of uncertainty, and it's up to us, the industry groups, the battery manufacturers, to educate people. There's still a lot of NIMBYism in solar and wind, and we don't want it to bleed over into storage. There's quite a lot of concern about what's going on in Nebraska and the possibility for some of those sentiments to spill over into adjacent Midwestern states. These are what we're focused on now.
No, that's great. And what about some of the non-competitive wholesale market regions like the WEC? I suppose with EDAM and Markets Plus, they might not remain that way for long, but would you consider looking at those markets or those regions, I should say?
Our strategy from the beginning has been to build batteries where our trading group wants to trade them.
Mm-hmm.
We do not really develop for the purpose of RFP winning.
Yeah.
Right?
Yeah.
There's great opportunities and great need in the Southeast, and it's a different investment, right? We want to make sure where we're building, if there are no more subsidies, if there are no more programs, we will build it because the supply and demand stack, the congestion models say this is where you should build a battery. For things like WEC, even, some of the central part of the US, Colorado and such, where there might be new trading opportunities, we are actively looking, but have not spent a ton of time until those markets develop a little further. There's so much opportunity for us in SPP, MISO, New York, New England, that's where the bulk of our focus is. But we do get a lot of inquiries about the Southeast and the Northwest. It's just difficult to take our market-driven thesis and apply it there.
That makes sense. And then within those competitive wholesale markets, obviously they vary considerably in terms of what the revenue stack looks like. I mean, given your background in commodities trading, do you have a preference for a certain type of revenue stack, or are you indifferent to, more capacity and less wholesale arbitrage versus, the other way around?
I'm a bit torn, right? I think that my history in power trading has shown that there's almost always a part of the U.S. that experiences a major heat wave or a major cold front, whether during the peak winter and summer or during outage season. And so to really have a proper investment thesis, you must be diversified across all regions. And so diversity is the main key from a weather point of view. From a revenue point of view, programs like Mass and Clean Peak, while they're new, are very attractive as a unique solution. I think the index solution from NYSERDA is another potential way to go. And so we're keenly focused on those two. Things like California, where you have contracted revenue with an RA contract, that makes it a lot easier to get a project built because that RA revenue probably keeps the lights on, and then the returns come from the trading around the battery. And so any capacity market like that makes it really attractive and easier to finance. But that's why you have so many people doing it, and it's better revenue perhaps, but also more competitive.
Yeah.
I think as Texas evolves, sadly, it's very path-driven based off weather outcomes. And so a big heat wave or a big cold wave, a big price spike or something, I think will dictate policy, but load growth is still at the peak.
Yeah, absolutely. It always feels in Texas like we're one heat wave away from some catastrophic public policy. But luckily, Touchwood managed to avoid that so far. I'd like to talk a little bit about the risk and implications for capital structure that you just hit on. So I mean, historically, probably the most common approach for most developers is that they're very happy to take on early stage development and construction risk, but when it comes to actually running the asset, they will often then offload that merchant trading risk either by flipping the asset outright or perhaps paying a third party to manage operations and trading. That's not what you do. You keep assets in-house and manage them yourself. So I suppose, well, first of all, why did you decide to do that? And maybe more importantly, how have you been able to do that, given that I'm sure many developers would love to be in the same boat and do that if they could, and if capital wasn't a constraint?
Again, we come from the commodity trading world, and we grew up in a landscape where merchant energy trading firms had a combination, as I said earlier, whether it was oil tanks or barges or ships, some logistics to help move product around the country. In power, that's time moving it from one time of the day to the other. And so we understood the value of, I think, trading around storage, making money from storage. Early on, we identified that a mostly contracted asset had the highest IRRs for a sponsor. And so that's the program that we have followed. There are some investors that like trading risk, and they are different investors than infra risk. And so the key there is, in many ways, separating the buckets, and so that the right risk-adjusted returns are paired with the right investors. The dev and flip developers, which represents the majority of the ones you mentioned earlier with the new nickel, a nickel for every one of them, they did a similar calculation, and they said, I can put a couple 100,000 or a couple million into a project, a couple years into it, and flip it and maybe make 2x, 3x, 4x, in some cases 10x what they invested in. So high return, limited in scale, but they could develop and flip and develop and flip. And I think we've seen many of them do that successfully. And in fact, we've purchased a lot of products from people like that. To actually build it required, I think, some different private equity structures, capital, a real view for the long term that we want to be asset owners in the space, and that the dev and flip folks would, their business model would come to an end quicker. And so we needed to be able to absorb the trading risk, trade around it. Long term, I think pairing storage with solar, wind, and load presents a much greater opportunity for Spearmint. We do want to be the first green merchant energy firm that pairs all the pieces together, and I think we're on that path now.
And so you're not just developing and operating your own assets, you're offering offtake to third-party assets. Is that a market that you think, maybe a broader question, how do you think about that market in the long term? Does that start to consolidate and there are sort of one or two big players doing this, or is there going to be a lot of folks, providing that sort of service and then some people doing it in-house? How do you see it evolving over time?
So in the asset optimization market today, I think we have evaluated 26 firms that provide quantitative trading around batteries. And they range from Monte Carlo simulation models to AI to any number of different ways of looking at the world. Many of them fail because they maximize revenue without properly risk adjusting the downside. And again, because we come from the trading side, I think we can find the right solution which manages a combination of risk and reward. And many of those software platforms are solely there to maximize returns, even if they're wildly, their distribution is quite wide to the right and left. And so I think we do a good job. I think that in the future, you can envision a world where there are 1- and 2-person shops that come up with quantitative solutions that provide day-ahead bidding strategies. I think it's harder in the real time. Day-ahead is actually much easier to solve, but in real time is tricky. And so you will have a wide variety of solutions. It'll eventually probably be 5 or 6 key players, and then maybe 5 or 6 sort of secondary players.
That makes sense. And even with the software platforms, it feels like there's always a human overlay. It's hard to completely softwareize this stuff. Even if you have the fanciest AI, there's still typically a human in the room telling, overriding it in certain instances.
I think, again, there are some firms in Europe that are fully autonomous. I don't think the US is there yet. But I do think that, I can envision a world where there are fewer people relative to computers.
So as you said, there's a lot of demand in the market right now for offtake. What sorts of offtake do you see as being most in demand? And are you finding ways to to structure contracts that allow folks to keep some of the upside, or is it, is it more just full toll of the battery and for a fixed payment?
That's so interesting. I think people's desires are all over the map. I mean, we see some folks who, as you know, are completely focused on merchant and keeping as much merchant as possible. And other folks want fully contracted because they want to then flip them to the institutional capital that wants fully contracted assets. And so you have to ask yourself, what buyer do you think will be the best buyer for your asset long term? We continue to believe that a mostly contracted battery is the most efficient. There are some batteries in some locations where we might prefer to go merchant because we think the opportunities are amazing. So I think that it's very much sponsor determined and the risk parameters of that sponsor.
Yeah. Yeah. And do you think it's a buyer's or a seller's market right now? I assume it's a buyer's market, but I'm curious to hear your views.
I would say that right now, buying early and mid stage and even late stage, not yet constructed projects is still a buyer's market.
Yeah.
I think for fully contracted projects, it's a seller's market. I think for those who need a toll on their battery, it is mostly a buyer's market, but we see some pockets, some nodes, some zones where there are strong demand for battery offtake, where those folks can't find batteries to rent.
Yeah. No, super interesting. But from anecdotally, we see it as mostly at least on the offtake side, certainly a buyer's market still.
But there are some places I can tell you very clearly where there is very strong demand for specific zones or even a couple of nodes where the bids are stronger than you would think, and that they're not finding the offers in the right location at the right time.
It's super interesting and reinforces that location matters, and that's why you have teams of people thinking about this stuff.
The by the pound sort of spray and pray approach, I don't think has ever been a good one. I think the only people who've made money on that were some of those develop and flip folks that literally just jammed stuff in the queue as early as possible and flipped it out. And that's what you have to be most wary of.
Yeah, the huge pipelines of bragawatts. Good. Just something I've always been curious about, but for firms like Spearmint that are managing both their own assets and third-party assets, how do you get around potential conflicts of interest in small markets like ancillaries, trading, both your own assets and other assets at the same time? Presumably there's some system of Chinese walls, but I've sort of always been curious about that.
And you look at all the asset management firms out there, they've been dealing with this for decades. And it's something that folks have gotten comfortable with. I think there are, if anything, more issues with queasies because a lot of those queasy relationships lead to bilateral contracts in the daily or the BAL day or the next hour. And so that is a place where I think we see more concern in finding the right queasy. And so we're very focused on alignment of interest in contracts and sort of finding ways to make people comfortable.
So far, I think we painted a fairly rosy picture of the investment landscape for batteries in the US, despite some of the nuances. Let's talk about a couple of the challenges. So from my perspective, one of the biggest risks we see is around market saturation. So ancillary service markets where batteries play are typically small. It doesn't take that much storage, such that the total volume of installed capacity is bigger than the total volume of ancillary procurement, at which point prices tend to crash. We've seen this in the UK recently. There are question marks around how quickly it will happen in different markets here. How do you think about the risk of market saturation?
I mean, in general, I think that it's a question of when, not if. And when
Mhm.
I say when, in reality, I think that if demand growth really is 6-7%, and we do get another 20 gigs of solar and 10 gigs of wind,
Yeah.
the volume of ancillary services will go up.
Yeah.
You start getting to those, I don't want to use the term unsolvable ramp because I don't necessarily believe that, but you get some very difficult ramps in the model that will necessitate additional ancillary services.
Yeah. And we tend to see that across market system operators. As soon as they start seeing batteries on the system and what they can do, they figure out a way to pay more for them, because they're, provide useful grid services. So that's on the market saturation piece. I'm interested in your take on supply chain as well. So, I mean, in the last couple of years, we've seen lithium prices skyrocket. They've come back down again. To the extent that the long-term viability of batteries is dependent on continued cost declines, especially for longer durations. How worried are you about the battery supply chain in the long run?
That's a very difficult and nuanced question. So our sustainability team is heavily focused on tracing supply when possible, working with our suppliers, battery suppliers, integrators to ensure that traceability standards are used, third-party validation when possible. We try and adhere as much as possible to US standards. We see increasing interest from federal regulators across the board in multiple ways on a number of fronts. We're also looking more clearly today at the European battery sustainability regime and the requirements for recycled content in batteries, something the Americans haven't gotten to yet.
Mm-hmm.
And so I think that there will be plenty of batteries. I think there will be very, very few that are fully compliant. And so we're spending our time really searching for the right partners, vetting them as much as possible. I don't think we'll get to a place where you have to rip out parts and replace them, the rip and replace. I don't think we'll get there, but we're heavily incentivized to solve the problem ahead of time.
Yeah. Okay. So total aggregate supply, not an issue, but ESG compliant, certainly concerned. So sourcing now is the answer.
We visited Asia last year, and we could point to tens of gigs of fresh capacity. And so there is no shortage of capacity. And so what likely will happen is that capacity will go to rest of world, and the more ESG compliant stuff will end up in the US and Europe.
Yeah.
I think that the demand for domestic manufacturing with the combination of the IRA for new facilities and the bonus for projects using those batteries will bear fruit. And we are currently working with a number of suppliers trying to identify the best partner.
Good. So before we wrap up, I'd like just to take a step back and think about the role of batteries in the energy transition more broadly. So, look, I mean, we've been speaking about all of this. So if you ignore some of the market level nuances, from our vantage point today, the fundamentals look pretty good. There's, rising load, increasing penetrations of wind and solar, thermal retirements. You just need a certain amount of storage to balance the system. What I'm curious to know is how far do you think lithium ion plus existing technologies can displace gas completely, or are lithium ion batteries just sort of a bridge to something else? So some other source of dispatchable low carbon generation. In other words, how far do you think we can get with lithium ion versus how much do you think we need something fundamentally new that we haven't seen yet?
I mean, I think that the lithium ion coming down in price so low is that next major event in the power space, and trying to look for another one is silly. I think that we probably have a 10-year rollout period here. We actually solved the problem. Price came down from 4,000 a kW to a couple hundred, right? It came down 95%. Now it's time to
Hmm.
deploy.
Yeah.
Right? I do struggle. Like we spent a lot of time looking at, peakers as a concept are relatively inefficient in the short run because the non-productive gas at startup is high. The
Hmm.
emissions during the first 15 to 20 minutes is so bad that some states like New Jersey even forced the retirement of their peakers. And so I think the days of the dirty peaker are coming to an end.
Even, I suppose, perhaps in the short term, I suppose in the long term, what is the right technology for that multi-day system stress event where you have low wind and the sun isn't shining so much?
Yeah, I mean, so you might initially go to gas and perhaps more combined cycles is how you
Mm.
can just solve the issue of massive load growth. But peakers don't achieve that. If there's one thing that we've shown is during Uri, the gas peakers failed because they couldn't get gas. And during some of the large New England, New York storms, they couldn't get gas or oil because supply failed. And so building capacity to protect against those cold winter mornings when the supply itself disappears, it doesn't help anyone, right? So we're very much of the belief that combined cycles likely will persist, but that peakers are the horse and buggies of the power industry. And they have a good lobby and they have really good PR, but that's just because they're a dying breed. Long term, I don't know if it's Form Energy or some other, as of yet, to be determined technology that comes through. I do think that currently lithium is the future for several years, and I await some new technology. I think that we were waiting for a storage technology for 30, 40, 50 years that was better than pump storage, pump hydro.
Mhm.
Compressed air didn't work. And so now we have it. And
Great.
so in reality, could it be hydrogen?
Mm.
Maybe. I'm a bit of a pragmatist, but I don't think it will be hydrogen, but it could be.
Well, I think I quite like the Liebrecht hydrogen ladder. It's for some use cases, certainly for power peaking, it feels, starts to get very, very pricey. But um good. I think that's a great place to wrap up. And for folks who would like a 30-minute summary overview of everything that you need to know about the US battery market, please the last 30 minutes is what you want to send to your friends and colleagues. But before we wrap up, Andrew, I'm going to list three things, and you're going to tell me if you think they're under or overrated. And you can add a brief explanation if you like, but not necessary. So the first one is the chances of the repeal of the IRA.
I think there is little chance of a full repeal, but I think there is certainly a chance of some changes to the program.
Battery tax credits within that.
I think there could be changes in terms of the sunsetting of the program, in terms perhaps of the sourcing requirements of the batteries, but I don't think that will be grandfathered. I think that the existing products will be grandfathered in, and I think that's more forward-looking from 26 out.
Hmm. Great. The second one is continued battery cost declines.
I do not think there will be battery cost decline. I think we've hit the bottom, and I think prices are likely to go up from here.
Hmm. And the final one is the concept of baseload power.
That's tricky. I think the evolving AI demand is a big wild card. If you really are growing at the speed that we think we are, the shape of that demand is not well known. And so if you're doing EV charging overnight, that helps overnight load. If you're trying to shift some of the data load to the middle of the night, that helps as well. So I do think that baseload demand is not a dying breed, and it will remain vibrant.
So underrated. Well, thank you, Andrew. This has been a wonderful discussion. It's been great having you on. That's probably a great place to wrap up. So thank you very much for joining us. It's been a pleasure.
Thanks so much for your time. I hope it was helpful. I feel like there's so much more we could have talked about, but I think this was a good overview of a lot of the topical issues today and what we're seeing in the market.
That was Oliver Kerr, Managing Director of Aurora's North America business, talking to Andrew Waranch, Founder, President and CEO of Spearmint Energy. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.